Lastly, I want to walk you through the hidden secrets of investing from an article that I did a few years ago that I think is timeless that you need to know. So I define my style as hyper acceleration or like catastrophic investing. So like last year, those are some of the ideal times. So whether it's on a short-term horizon or long-term, I like to get in on the edges. So write this down. Rule number 1, do not give up more than 1.6% on any trade. I don't care how much you love a company, you don't want to draw down. Now for long-term investing, you have to give it some space. So I'm not recommending that you close out at 1.6% loss. I can do it, you can't. I don't want you to do that. But this is a game of retention. And one of the biggest mistakes that I see people make, they make huge losses and then chase to then get back. This is just free game for you guys so you can apply. Number 2, do not forget rule number 1, do not lose money. Investing is about mitigating risk at all costs. And once you do that, the money's there. How many of you have ever, and we're talking about this today in Dream Team, how many of us have spent money in the club or on clothes or on things to show status when we could have just had the status by investing in great companies? Most people treat their portfolio like cash in Vegas and they're just gambling. And I don't want that to happen to you. The number 1 focus in every single trade, every investment that I make, I'm thinking, what is the potential for this stock or investment or deal to harm me or cause me to lose? I only want to pick the ones that are going to give me safety. Number 3, only take trades that will not lose, especially for my swing traders and day traders. You're not going to have a great setup every day. You can't trade every day. For me, I'm fine if I get 2 to 3 trades a week because I know the ones that I'm going to take, I have a high probability of winning. And I know it's tough to sit to wait for a perfect setup, but it's much better than being down 7, 15, 18, 29, 50%, 60% drawdown. And then if you are looking at it from a competitive landscape, for those of you who may want to go work in the industry and then trade for a firm, the track record that you want to present is one where you don't have many losses. And when capital is given to you, you are known to grow it. Being flat on a day beats being negative any single day of the week. Number 4, you have to get the direction right of the market at all costs. If you cannot pull up any stock, ETF, currency pair, crypto, and you can't tell what the direction is in 30 seconds, you do not know what you're doing. Master that part first. Master that part first. If all the cars on a highway are going north, you want to ride north with the flow of traffic. When you're trying to short a market, and that's when everyone tries to pick tops and say when we're going to fall apart. Normally, we're only going to draw down 50% anyway, but you're missing out on the upside, the big long pause, all that, right? You're missing out on 500%, 700%, 1,000, 2,500, because you're the places in which when you're drawing down the most, and the market is drawing down the most, as shown with Benner cycles, right? You should be looking to buy long-term to hold those assets any damn way. 11-1, snipers, kudos to you. You know this. 11-1, asymmetric reward to risk ratio. I want to risk $1 to make 11. Now, if you're able to do that, how many times will you put money in that machine? And then also, once you get up, let's say 10% in an investment, you want to lock in 2% for safety. So, and I make this analogy, like, let's say you had $500,000 in your house. Locking the door is like your stop loss. But what if you had insurance on that money that you only paid $100 a month for, that even if the money was stolen, you would then be able to recoup your $500,000 that was in your home? That's not a good investment, but I want you guys to get the analogy. So lock in profit to be safe in every single trade that you make. Taking huge risks to make small gains, you don't want to do that. Please screenshot this or write this down. In day trading, you want to risk 1 to make 5. In a mini swing trade, you want to risk 1 to make 15. And a longer swing trade, you want to risk $1 to make 34. And in your long-term investments, you want to risk 1 to make 50. This is the matrix. Day trade, I'm saying it once again. You want to risk 1 to make 5. A small swing trade, you want to risk 1 to make 15. And a long swing, stocks or futures, you want to risk 1 to make 34. Long term, you want to risk $1 to then make 50. Stop asking me about plays and flipping. You're going to flip yourself and play yourself to being broke. And some of the hidden secrets, there's no such thing as a bad market, only entries into it. When you guys ask me, hey, well, what you think of the market is good every day. Whether it fell 700 points or went up 700, the market was good. It depends on when you got into it. Number 2, yes, the market is rigged, but it's rigged to stay up for long periods of time, especially with quantitative easing. Number 3, getting the direction right is more important than anything else. A lot of you get destroyed on getting the direction wrong and be like, well, I thought go with the predominant direction and you'll be fine. Number 4, the market can only go from a high to a low or a low to a high. That's it. That's investing 101. That's all you need to know. The market can either go from a low to a high or high to a low. And 5, your performance in the market has everything to do with your preparation and what's floating around in your head in the market. That is it. Please write this down. Stop buying in the middle. You want to buy at the edges. One of the biggest mistakes people make is they want to buy in the middle, especially in their trades. You want to buy when things are at extreme lows if they are an incredible company, and you want to refrain from buying when it's at its all-time high. And my last rule for traders especially, never trade without a stop loss. I know people like to have naked positions, and there are some advantages to doing so, but in the event of a flash crash, power outage, slippage, market makers stop hunting, right? Things can occur and they'll push other stops down and to break the market. So if you're in at $110 and they push the market down to $93 and then you have $115,000 invested and now you're down 62,000, there's nothing you can do. Once again, my first thought is, what can I do to mitigate disaster and eliminate losses?